All right, let's jump into the taxation bucket, talk about the taxation of real estate. We've actually already done a fair amount of this as we looked at 1031 exchanges and the taxation of real estate. So this should be largely review here. Um, so we're going to start with the notion that operating income from real estate is taxed, and it's going to be taxed as at an ordinary rate, ordinary income. And from the NOI, from the net operating income, we're going to make a few adjustments. First, we're going to take out depreciation because depreciation reduces the taxable income. So we're going to depreciate our asset, and if it's residential, which is the property where we're talking about, we're going to depreciate over a 27 and a half year useful life. If it was commercial, it would be a 39-year useful life. We can also reduce our operating income by the interest portion of our debt service. So that reduces our taxable income. And then finally, we can amortize any bank fees or points that we paid once we get our loan. That also reduces our taxable income. So that's why we had a 2-point fee with a bank, because we're going to go ahead and actually amortize that, not depreciate it, but amortize it. So when it comes time to sell the property, we are going to do the depreciation recapture. So that's going to give us basically additional money that gets taxed. That's going to get taxed at ordinary rates. And then any increase in the value of the property is going to be taxed at capital gains rates. So anything that we made kind of over and above our purchase price. And we looked at that in our very first, the transaction bucket. We had the purchase price, the gross amount that we paid, then we had the net sales proceeds. The difference between those two numbers are going to get taxed at the capital gains rate. So let's jump into our calculation, and I'm not going to do it here. I'm going to build it step by step in the spreadsheet. So let's go there and scroll down here. We're going to add in some new stuff. So we're going to add in the taxation. So let me put that right here. So this is the taxation of the real estate. And so the first thing we're going to do is actually split apart our debt service payments into its constituent components, namely principal and interest. So we're going to split that up, and we can do that one of two ways. We could either compute the principal portion and then let the interest portion be the residual, or we could compute the interest portion, let the principal portion be the residual, or we could use the function to do both. So I'm going to just start the way we have it laid out here, and I'm going to use the cumulative principal function, so cum prints, and let that tell us how much principal we have paid for this year. So the first thing we need to do is refer to the rate. So I'm going to go up and link to the rate and divide that by 12. The next input is the number of periods. We are amortizing this based on a 25-year window, so I need to multiply it times 12. The next input is the present value, so I'm going to link to the amount of loan that we had. The next thing it says is the start period. Now, let's think about what I want to have happen here. And this starts to get into a little bit of the tricks and thinking about how to use Excel. I want my start period to be period 1. By the way, these are in months. So I want my start period to be 1, my end period to be 12. So I'm basically telling Excel over the first 12 months of this 300-month amortization, how much am I paying in principal? So if I want it to be month 1, watch what I do here. I'm going to go up to the time subscript, or I don't know if it's a subscript, just this time indicator up here, 0, and I'm going to multiply it times 12, because that'll tell me how many months have gone by the end of that year. And of course, 0 times 12 is 0, but I'm going to add 1 to it, and that gives me the resulting piece is going to be a 1. And hopefully it'll become apparent to you when I copy this formula across. If I'm looking at the beginning of, or the period from year 1 to year 2, my beginning month would be month 13, and my ending month would be month 24. So if I move this across and think about what would happen if I had a 1 there, well, 1 times 12 is 12, plus 1 is 13. So this little formulation here gives me the first month of the year that I'm concerned about. And then my ending period is just I'm going to go up here and multiply this cell times 12. So the stuff that I've put into my formula is going to tell Excel use month 1 and use month 12. And of course, when I copy that over one cell, it's going to say use month 13 to month 24, and I'll show you that here in a second. The type, I'm going to go ahead and put in a 0 for end of period cash flows, and then hit enter, and then I want to format this. So let's just talk again about my time thingy here. So when I copy this over, oops, so the bad thing is I did not I did not make an absolute reference where I should have. So there are a couple of numbers in here that are absolutes. C6, my interest rate, is absolute, and H15, the loan amount, is an absolute. Oops, and this is an absolute, the term of the loan. So let me copy those all, make them F4, and then if I copy this across, 9,172 in the second year would be principal payments. Let's go back to my starting and ending periods and look at that. So the start period is now going to be year 1. It's going to look at the 1, and it multiplies 1 times 12 and then adds 1 to it. So I'm telling them the start period, or Excel, I'm telling Excel the start period is month 13, and the end period is going to be this thing times 12, so 2 times 12 is 24. So it's doing exactly what I want it to do. It's going month by month over those 12 months in year 2. So 13 through 24 is 12 months that comprise year 2. And because I've set this up properly, I can just lickety-split, copy this all the way across, and I've got my cumulative principal portions for each of those years. Now, I think I'm going to just kind of cut to the chase here and do the simple version of the debt portion. I could use the cumulative interest, cum-I payment, cumulative interest payment. But instead, I'm going to just take the difference between my debt service and my principal payments. By definition, that's going to be the interest that I'm paying. So let me copy that all the way across. And so I have this row of numbers, and I'm going to do a little highlight here and indicate that this is affecting my taxable income. The first line, the principal portion, does not affect me, but the interest does. Now I have the next little portion here that tells me I'm going to highlight my depreciation and amortization. So the first thing I'm going to do is I'm going to amortize my loan fees. So I'm going to link up here to my loan fees. I'm going to lock it in with an F4, and I'm going to divide that by the term of my loan. So 10 years I have this loan. That means I can amortize that amount that I paid up front over a 10-year period. So again, I'm going to format the cell to look like all the others, and then I'm going to copy that all the way across to, did I not? Oh, the 10. This D7 should be absolute as well. So it's a frequent way of doing spreadsheets. You got to kind of iterate and fix all the problems that kind of pop up their heads as you're moving through. The depreciation is the next thing, and what we need to do is actually go over here to the left and talk about something that we haven't talked about to this point. Our cost basis is the total purchase price that we had. We've already talked about that number in the transaction bucket, $583,625. To get the depreciable balance, we also need to take into account the land value. And so because land is not depreciable, we're going to subtract out that value. And just for simplicity, we're going to assume that that is a $100,000 number. Let me go ahead and make that an explicit assumption. We're going to put that number in there. And so our depreciable basis is $483,625. And so when I'm calculating my depreciation, I'm going to take that number, the $483,625, and divide it by 27 and a half years, because that is the residential number. Let me format that. Oops, and I should make it a negative because this is an expense. And I should also F4 that to make it an absolute reference. So I'll go ahead and copy that all the way across, and I should have a whole bunch of 586s. I do. And let me go ahead and highlight these in that special taxable cash flow kind of a color. Even though these aren't cash flows that we're paying per se, they do affect our taxation. So now we're going to figure out what the taxes are on our property, what the tax cash flows would be. So for our NOI, I'm going to just refer up where we did NOI before. I'm going to link to that cell, and that's going to capture my NOI. The interest payments that I have are going to be right here. My amortized loan fee is here. My depreciation is here. And so my taxable income is just going to be the sum of those parts. And I've got a negative taxable income, negative $6,085. Let's go ahead and go across all of these things, and hopefully we're not going to have any absolute formula issues, and we don't. So you can see how our taxable income changes over time. It grows until the final year when we have $21,000 in taxable income. Our tax amount is going to be the negative of this number times our tax rate, and in particular times our ordinary tax rate. So that's given up above. Let me F4 it to lock it in. And so in the first year, we actually have a tax benefit. We, in effect, are getting a refund from Uncle Sam for the $6,000 in losses that we have from our property. So we got $6,000 in negative $6,000 in taxable income. If we had positive taxable income, we would have to write a negative check, right? We'd have negative cash flow. It's the same thing. It needs to be an opposite sign. What is happening in effect here is that by virtue of us having a taxable loss on our real estate, it's reducing our taxes elsewhere, either within our real estate empire, or if we're a W-2 employee and we get taxable income on other things, it's going to reduce our taxes. So we're paying $1,521 less in taxes in year one because of our real estate than if we did not have the real estate. So we do need to have that as a positive cash flow, even though it's in the tax category. I'm going to copy that all the way across here. And you can see eventually we're going to be paying some taxes. And then the last thing we need to do from a taxation standpoint is to look at some taxes on the sale of our property. So the first thing we have is the depreciation recapture tax. So I'm going to first recapture all of our depreciation. So it's the sum of all of our depreciation here. And I need to put a negative in front of it because it's kind of like a reverse sign. We're recapturing all those negative cash flows. And our depreciation tax rate, depreciation or recapture tax rate is 25%. And so there we have our basically a little piece of the disposition tax situation. The next piece we got to take into account is how much we made on the sale of our property. So let me go ahead and, go ahead and put in some other stuff here. All right, so in terms of the gain on the sale, we need to look at our net proceeds. And so if you recall, that's way up in our transaction bucket, way up here. So the sum of those two numbers tells us, what happened there? Let's try that again. Equals sum of, way up in the transaction bucket, those two cells there, says that when I sell it, I got net proceeds of $750,262. My purchase price, recall, was up in my transaction bucket. Oops, and I don't need a negative there. Let me get rid of the negative sign. So I paid $583,625. That was my cost bucket, or sorry, my cost basis. So the sum of those two numbers gives me my gain amount of $166,000. That gets taxed at a 15% rate. So now I have enough information to figure out how much my tax is going to be, what the total tax on my sale would be. So let's do this. We've got the tax, no, let's go down here. My total tax is going to be negative that amount times that amount. And let's just stop there and think about what that's telling me. The tax on my depreciation recapture is $43,966. So that's how much I'd have to pay in taxes just for the depreciation recapture. Now let's finish off this thing and do another little calculation. I'm going to say negative of that, so the $166,000 gain times the tax rate. So this keeps everything in a negative sense because I've got the taxes being a negative cash flow. And so my total tax on the sale is $68,961 to the negative. Now we are ready for our exciting conclusion. We're going to look at the after-tax cash flows for our property. And to get that, I'm going to look at my before-tax cash flows. So we did that up here. Where is it? Right there. This row right here, before-tax cash flows. I can refer up to that stuff that I've already done. And in my taxes, I've got this as my tax amount for my operations, and I've got this line for the tax on the dispositions. So I can copy that across. And that leaves me with my after-tax cash flow, which would be the sum of both of these numbers. And finally, I can do my after-tax IRR. And this would be an after-tax leveraged IRR, by the way, because we've taken into account the debt. So I do that. Let me expand this a couple decimal places. 13.64% is my after-tax return after I've taken into account the leverage bucket and the taxation bucket. So 13.64% is my return at the end of the day. And if I go on to this very last slide, I see all of this stuff has borne out. So that is investment analysis. That's building a pro forma. I've done it step by step for you. We've worked all the way through the acquisition, the transaction bucket, the property bucket, the financing bucket, and finally the taxation bucket. You might need to watch these videos one more time, especially the last 2 or 3 of them, to get the details of this pro forma building. I would suggest you actually break out a spreadsheet and do what I did. Build this yourself if you really want to learn it. You're not going to learn by watching. You're only going to learn by doing this. And so take the time. We'll do this in class. I'll give you a chance to do this hands-on in class, but you're probably going to have to spend some time outside of class getting your hands dirty in Excel to make this thing work and to make it stick in your brain. Just watching will do nothing. Doing it will give you a chance of getting this right on the test. So this will be a big part of the third exam. So start working now to get ready for that one. All right, I'm going to stop here, and this wraps up our videos for this particular content, and I will see you in Chapter 12 videos as we talk about alternative financing. So I will see you then.